Thank you very much, everyone, for joining us tonight. As always, on a Tuesday afternoon, a few days before the holiday break. This is a fantastic turnout. We greatly appreciate you being here with us. For those of you who don't know me, my name is Laura Nieves, and I head investor relations here at Astor Realty Capital. As I mentioned before, we're very excited to have you here today, and we're very excited about the topic that we're going to be discussing this afternoon, which is walking you through the next and the first opportunity within the One Astor Income Fund. Before we dive in, I would like to briefly introduce Astor for those of you who may be new. Astor is a private equity real estate firm with over 65 years of collective executive experience. To date, we have participated in over $3 billion of real estate assets across 13 major top performing US markets. That represents 38 investments and 17 exits. We have an average return of 21.3% annual returns to our investors since inception. Our portfolio today spans more than 3,600 units and 4.6 million square feet. And our focus has always been disciplined execution, downside protection, and long-term investor relationships. Tonight's session is going to be hosted and led by our founder and CEO, Joe Burko. Joe is a highly esteemed entrepreneur with over 30 years of experience in the real estate industry. As our founder and CEO, Joe has led Astor to the forefront of the private equity real estate investing industry, and we deploy capital across major US markets through a strategic combination of equity and debt. Under his leadership, as I mentioned before, we have participated in a portfolio of diversified real estate assets, and our focus is always risk-adjusted returns and capital preservation. Joining us tonight is also Andrew Milbank, our Chief Investment Officer, who oversees Astor's investment strategy, underwriting, and portfolio management. And we also have Alex Mulcree, our Senior Analyst, who is playing a key role in deal analysis and structuring. So on that, I am proud to turn you over to Joe, who will walk us through tonight's agenda on Ironbound Newark opportunity in more detail. So over to you, Joe.
Thank you very much, Laura. Happy holidays to everyone. It's really unconventional to do a Zoom presentation to investors sort of like, hours away before the holiday starts, but we decided to do it anyway. The turnout is not great, but I appreciate each and every one of you have actually taken the time to join us on this new exciting venture. So we spoke last week or a couple of weeks ago about One Astor. We're really excited about this structure. We'll be able to include many of you, individuals that will not be able to participate in previous deals because we got oversubscribed. Thank God for that. It shows us how strong the demand is specifically for those type of deals, the kind of deals that are generating income to you, the investors, on a quarterly basis with an annual pop. Everybody loves those. And so we've decided, with that in mind, to create a small structured fund that will allow you all to participate in a very even-keeled way in 6 different transactions that we're planning to do, all of them focused around one segment, which is creating income and distributing on a quarterly basis. The first transaction is here. We're very excited about it. We'll talk about it this evening. It's a $7 million B piece. We'll explain that in a moment, generating between 14.5% to 16%, which is sort of like what the fund is about. And it's located in the Ironbound Newark, New Jersey section, nice blue color section. Let's move over. Do I have control over this? Or yes, I do. Okay, very great. So our property tonight, property number 1, is located in 33 Magazine Street, and it's sort of like the heart of the Ironbound section, which is a segment of Newark. Newark is known to be an industrial spot, obviously a large airport area, very easy access, very easy transportation, highways, and of course, short drive to Manhattan. An area that over the years have gained a lot of traction from young professionals, from artist community, and so on and so forth, finding loft living and all sorts of kind of like mini industrial being sort of like the cool spot for this generation. But it also surrounded by a lot of good blue collar type of individuals and families that are living there and made Newark and Ironbound specifically their home. Within this wonderful neighborhood, there's a family that's been building for the last 35 years. We'll talk more about them, their experience, how they're connected to the community. What they decided to do is build 108 apartment buildings. They buy the land. They bought the land some years ago, got the approvals, and eventually came to us to fund this project. This is a project that we're going to be lending $23.25 million, $23,250,000. And Astor at this point will become the bank, right? The bank that will help this project go vertical through construction. The exit is going to be when the project will be complete, stabilized. The borrower will go to the next bank who's going to refinance and give him like a steady 5, 7, 10-year loan, and with that will take us out. We'll repatriate our capital at that point. We're looking into a very simple project, essentially building 108 units, group that's been around, as I mentioned, good reputation, working with various banks. We've toured some of their asset. We were able to negotiate a very interesting point, which is in event of a default, God forbid, but we always have to think about what happens in the worst case scenario, not just the good case scenario. In event of a default, we also have 2 additional buildings that we can use as additional collateral just if the worst should happen. And what we're doing here is we're bifurcating this loan. We're basically taking a $23.25 million loan. We're bringing a local bank with us to participate. The local bank is now going to be giving us $16.25 million. And we're going to be charging 11.25. We pay the bank 7%. We're creating what's known as the arbitrage, the difference, the delta between what the cost of capital is and the amount of money that Astor Fund or One Astor Fund is placing. And that arbitrage essentially allows us to generate close to 18% return. And this is how we're able to generate to you, after fees and some of the promotes, somewhere in the vicinity between 14.5% and 16% on your capital. So why invest and highlight and why we like this property? It's an experienced developer, as we mentioned. We love working with people that have good experience, good track records, because those are the guys that will tend to do less mistakes. They know what they're doing. They've proven to us time and time again across the street, literally across the street from the site where they're planning to build 108 units. They already completed a 90-unit apartment building, which we toured. Looks amazing, fully occupied, great retail. half a block away from there, another 37 units that's been built, fully occupied. We walk within both properties. Those are going to generate additional security for us because we have a pledge of the equity on those properties. Those two properties, the existing properties alone, are somewhere in the vicinity of $14 million additional collateral, which we'll take. The site is obviously fully ready, shovel ready, has a pilot program that's in the making and is fully entitled. The anticipation is that this project will take around 24 months, give or take, out of which we're going to be collecting our interest. We, in fact, reserving the amount right off the bat. So the interest that we're going to be paying us is already sitting in reserve with us from day one. I feel that this is a very strong risk-adjusted return because they're building to a very high yield, creating tons of value, and we're stepping into a project with which has a good amount of equity in it already. And we like the location. We like blue collar. We appreciate sort of like building to the middle market, exactly where I keep on saying it, where the most of the demand is. Give us nice, affordable, good amenities, and without having to break the bank, right? Good for young families, good for individuals, and so on. Maybe we can switch to another page. Okay, here we are. So investment structure, I'll give it over to Andrew to take it from there.
Perfect. Thank you, Joe. So as Joe mentioned, right, we have a local bank that is participating with us in the 23.25 million loan. They're going to be providing 16.25 million. Their terms are 1 month SOFR plus 300. SOFR today is about 375 to 350. Our loan is SOFR plus 725 with a floor of 400. Okay, so we immediately have an arbitrage because of the leverage that we're taking with the bank. That's how we're able to generate higher returns on our $7 million than what the total loan is. Plus, if SOFR drops down a little bit, we're actually going to see improved arbitrage because the bank has a floor of 350. So we can actually capture an additional 50 basis point spread and see boosted returns from what we are projecting. Okay. I'll spend a quick second on what does risk-adjusted return mean to us. I'll give a quick shout out to Eric. Just before this call, we had a Zoom with him regarding the fund. And he kind of asked Joe and myself, why do we like this deal, right? Do we like this as much as other deals? And I think you looking at deals on the spectrum of risk, right? We have our LP equity deals. We recently did some fantastic deals in Florida, 350 unit ground up. Those are projecting, 24 to 26% net annual returns, right? Higher upside, a little bit higher risk, right? We think we've mitigated that with the debt on the property, the experienced sponsor, great location, all that kind of fun stuff, right? Many of you have invested in the preferred equity deals with us. A little bit lower return, but also accordingly less risk. On a project like this, right, we have full control over the deal. Okay, we are the lender here. We're the senior position. We're the first to be paid when the deal has cash flow, when they refinance, when they exit, whatever their strategy is going to end up being, right? We're running the documentation, we're running the servicing, we're doing the construction monitoring, we've engaged the third parties. So we have full control over the deal. With that, the return is going to be a bit reduced, but we're sitting in the superior risk position, right, relative to the capital stack of the project. Okay. Regarding third parties, I'm happy to say we already have the appraisal back, pretty much hit exactly where we expected, and I'll touch in a second on the land value. So that's a little bit about the investment itself. We'll go, one more page here. So talking about the returns, many of you are familiar with our structure at this point, core, select, and premier investor category. This is going to be based on the amount invested across your existing portfolio with Astor. Because of the minimum investment size of the fund, we expect most investors to be in the select category, but for some newer investors, right? You'll be in the green category here. Across the board, we have a 1.5% asset management fee on an annualized basis and a 12 to 20% promote on the net cash flow. So what we are looking at here is 14.5 to 16% net annual IRR. So net of fees, net of promote with the current cash flow, right? Because we're in the loan position, we have the interest reserved. We're able to make payment on a quarterly basis. Okay, the net average annual return, a little bit higher, but I think the IRR here, because of the ongoing cash flow, is a better representation of the overall returns. Okay, I'll touch briefly on the capital stack here, right? Two things that I think are very important for this project. We have the land here, right, at about $3.4 million, right? The appraisal has the land at $5.4 million, right? We were already relatively conservative in the value that we were giving the borrower. He's been working on this project for years. Okay, as Joe mentioned, he's got two other projects down the street. This is going to be the third, so he's going to have almost 200 plus units, almost 250 units on the same block. He knows the area inside and out, and he spent a ton of time. You can see he's got significant cash equity in the deal at this point, working on entitlement, working on plans and permits, and working to achieve a pilot, right? That's payment in lieu of taxes. That is a very favorable tax abatement that adds anywhere from $6 to $8 million in overall value to the project. Okay, so we're very happy with where those values are coming in. And we've said a couple times now, he's built two projects literally down the street from this. We love that when we do our deals in South Florida, we do our deals in Brooklyn. Developers that have built the very similar projects in that area, they know the cost, right? Like the back of their hand. So we're very, very confident in the hard cost projection here, the largest item in the budget, and their ability to hit that budget, stay on track. They're going to be using very similar, pretty much the same contractors, the same architects, the same engineers that they've used for the past projects, they're using on this project. So gives us a very good level of comfort. We'll turn it over to Alex, introduce Alex here, as Laura mentioned, the senior analyst at Astor, talk a little bit through the rent comps and the pro forma.
Thanks, Andrew. Yeah, we have divided the way that we are presenting these rent comps into two different areas. We have this layout here where we show the different ranges of the comp set that we have, from the minimum to the maximum for both the unit, the price per unit, the sizes, and the dollar per square foot. And you can see here at the very top, we're 33 magazine. We fit right within, I guess, this comp set, with many of these comps actually outperforming the prices that we are projecting here. We have another slide here for the two-bedroom units where we have that same structure. Again, we're at $2,670 per unit. And many of those within this comp set here are actually outperforming those numbers here. We actually fit in very favorably also with the sizes. And then in terms of the price per square foot, we're also fairly equal. The other way of displaying the comp set here is this one here, which I personally like a little bit better because it dives a little bit more into detail and shows side by side with the subject property. So we have 33 magazine here on the left-hand side, and we have the average of the comp set here, if you see my mouse, to the right here. Andrew and Joe have both mentioned a few times now that the sponsor has built two different buildings adjacent to this property, which is 325 Ferry Street and 15 Main Street. So those two buildings here are literally across the street from the subject property. If you pay close attention, they have an inverse unit mix to 33 magazine. So more two-bedroom units than one-bedroom units, and the sponsor's looking at, I guess, correcting that unit mix by providing now more one-bedroom units. So now, how do we compare to the market? We looked at apples to apples within the direct, I guess, vicinity here. We found 20 studios much smaller than our one bedrooms, and yet they're more expensive than ours. So on a price per square foot, the market is way higher than ours, at the same price point per unit, um, while offering smaller units. So right off the bat, we're fairly competitive here with our one bedrooms. If we compare ourselves to the other one bedrooms in the market, we see a $200 discount at our building, whereas the others are $200 more expensive. On the two bedrooms, the two bedrooms are actually comparing fairly well. Part of the reason why we're, fairly on point and not, you know, I guess the other buildings are, some of them are over achieving the rents that we're projecting, but you have to basically factor out the two buildings right next door, which, are hitting the price points that we have underwritten in our building. But once you factor those out, we're at 3,600, 3,000, and $3,500 for those two bedrooms. For the pro forma, we're estimating or underwriting just under $3 million for the gross potential rent. And we're factoring in a healthy amount of vacancy, concessions, and bad debt. And then we're adding back in, amenities, parking, and storage income. So basically everything that we can see from the other two buildings the sponsor has built. And then we also, deduct some expenses that we can compare to how the other two buildings that the sponsor has built next door, um, you know, um, basically we can subtract those expenses there. What we're left with is a $2.3 million NOI, which, one of the previous pages is calculated to just under 10 debt yields, which is really healthy. With that, I'll give it over to Andrew, who will go over the market.
Perfect. Thank you. So we'll touch briefly on this. There's plenty of information in the presentation and the due diligence. So you're welcome to review all of that. Um, as Joe kind of touched on before, Newark has a ton of job opportunities here, right? It has excellent transportation into Manhattan. You have excellent access to Route 78, major thoroughfare in New Jersey. You have the Prudential Center and all the kind of supporting entertainment around it, right? So there's a lot of really good reasons to live in Newark. The Ironbound section is a little bit more desirable, right? It has a lot of good restaurants, things like that. We've seen the flock of young professionals here. We see the young professionals when Joe and I toured the borrower's existing assets. There's a very good mix of tenants in and out of the building, going here, going there. So very strong tenant base, and he's consistently 100% occupied. Filled up the 37 unit building in about 60 days. All right, a very, very good absorption of property here. So we really like that. I'll touch again, right, the land sales comps. One of the things that makes Newark, right, desirable, it's very difficult to actually assemble parcels of land. You have really small lots. Many of those lots are owned by individual families and they've been owned for years. So actually assembling enough property that you can do a development of this size is difficult, right? So we had to draw from kind of a wide area just to even find comparable sites. And we have the appraisal coming back at 5.4 million, right? So a healthy value there that we have in the land. And then same on the exit sale, right? So our project is $275,000 per unit. Okay. Our loan is $215,000 per unit, right? Our last dollar basis of our $23 million loan is $215,000 on the 108 units. You have sales comps, right, from 350 to all the way up to 600. Now, we think that 350 to 400,000 range is more reasonable for this project, and that's where the appraisal came back in pretty much right in line with what we're expecting. Uh, Not going to make any predictions about interest rates. That's really, beyond my scope. But it does certainly seem like we are at the, kind of at the end of the interest rate being higher. Fed has been slowly starting to lower their target rate. That's been affecting interest rates on a downward trend, right? We've gone from a period of permanent loans being that 5.5 to 6% range. We're now seeing permanent loans in the 4.5 to 5% range. The borrower right now is doing an agency loan on the two properties that he has next door. So certainly you could see that there's a potential for the property to be valued higher than that in the future. But even at a $38 million valuation, we're in a very, very comfortable territory with our loan at $215,000 per unit, when the property should be able to sell for $350,000 to $400,000 per unit. Back to you, Joe. Talk a little bit about the borrower, and then we'll finish up with a bit on Astor.
So we're talking about an individual that started in real estate in the 80s. We sat down and during a borrower interview, he was quite an energetic guy, exactly the type of character I want to see when we're talking to a developer, a go-getter, sympathetic to the community. Very much fine-tuned in the details, the kind of guy that likes to put on his boots in the morning and go to the site, not the type that sits in the office and, give orders over email. And very much involved with the various trades, with the electricians, with the mechanics, with the cement guys, all that good stuff. We did a tour of the property. I have to say, I was very impressed. This particular building that you're seeing here, from the lobby, the design of the lobby made it look very, very cool. Everything was very nice, very, very nice, very clean, very well maintained. It makes you feel very good. Knowing also that those potentially could be additional collateral made us feel extra special. So again, Gary has been around the block for quite some time. I've seen a number of cycles. Learn the hard way, not to sell properties. He sold properties earlier in his career. Right now, he sits on properties, which is also a very positive sign for us, because when we see somebody who builds to hold, usually those guys will do a fantastic job. They will not cut corners. Will make sure that things are done in the right, proper way. There is a pilot program here, so he does get a tax abatement. The other two buildings have also received the same tax abatements from the city. And overall, I have to say I was very impressed. Another thing that stood out to us is, while most developers are syndicators, in other words, they bring 5%, 10% of the equity to a project, they go out and they raise money through groups like us. Nothing wrong with that. This particular guy does not work with investors. From the very beginning, he was lucky enough. He builds homes, he sold them for nice profits, made really well a return for himself, and always used his own capital. And so we like that as well. In this particular project, he's actually joined by his brother, who's a partner of his in many of the other projects that they've done together. And yeah, we're very, very pleased. So those are the two properties that were done across the street. There's nothing better than to see a guy that sort of like manages his own properties, third-party management, but still manages his own property, leases his own properties, very much fine-tuned to the community, the renters. We walked through the building. There was plenty of hellos. People were smiling. It feels really nice. If you're a bad landlord, people don't smile at you when you walk down the hallway or when you meet them at the elevator. So those things we pay attention to. They may not mean much, but they actually say and speak volumes about the individuals and the way he runs his operation. Some of you here are new. Not you, Adi. I mean, I see some of the questions here. I'm trying to kind of like juggle. We'll get to the question section in a moment or so. But for those of you that are new, a couple of words about Astor. As we said earlier, the collective experience of the executives of Astor is 65 years. I have started in real estate in 1995, which this year represents 30 years for me in the business. We are now investing in 13 top performing markets across the United States in 7 different states. Those markets represent areas where there's population growth, job growth, and particularly a particular segment which we pay attention to, which is an age group that averages around 38 years old. Like Laura mentioned earlier, our portfolio in participation overall is about $3 billion, $258 million from inception. I was asked today how much money we have on the management today, market to market. So I'll get back to the nice gentleman sometime tomorrow, I hope. And overall, through all of our strategies, right, through the equity strategies, which are also very popular because they generate somewhere into the low to the mid 20s to our investors, through the debt strategies and through the preferred equity strategies, combine everything, we're generating today 21.2% average return and over 3,600 units and 4.6 million square feet. It's quite a number, 4.6 million square feet in various locations. As I said, I've been around the block since 1995 and started in New York City. My career started as a commercial real estate broker. I ran my own shop called Burko and Associates. We've done hundreds and hundreds of transactions, both in the finance side, capital raise side, and investment sales. My last transaction was in 2015. Immediately after, we morphed the company into Astor Realty Capital. And instead of focusing on working with developers, we started focusing on working with you, the investors, representing your interest, because we saw that the one segment of the entire universe of real estate is missing representation, and that is you, essentially, if you think about it. The developers are lawyered up and they know what they're doing. The fund managers, the public companies, everyone's sort of like really set up with all the layers and all the structures. It's the actual capital that's missing that type of representation. And so what Astor does above and beyond everything else is we place capital together. We create power, what I like to call sometimes the bargaining power, right? That we have when we come together as a larger check to negotiate better terms, to negotiate better control, just equally as important to have control. A lot of times investors go into a project, they don't have control. If you enter a project with a couple of $100,000, with $500,000, with $1 million, you're still a small individual and you don't really have eyes and ears. And this is what Astor does for its investors. We are the eyes and ears on those projects. People have been with us for quite some time. Alex, maybe one of the youngest members of our team, is now going on 8 years. Laura, around 12. Andrew, just about 12. Others that have been with us for a good number of years, and we're very steady. And recently we started adding second generation. Maxwell Burko is now overseas volunteering for the holidays. The things that are important to us, competitive advantage, as we call it, is preservation of capital. You work hard for your money. We want to make sure that your money is there, preserving, not just creating, not just growing, but being preserving. And so whenever we have a transaction, we always look at what if things don't go the right way, what will we do then? And if the answer is we don't know how to get out of a transaction, then we don't do it. And ongoing asset management is what I've mentioned. Basically, the essence of what we're doing here is this asset management, so you can stay home, so you can rest assured that you have a team that's looking out for your interest, not just taking information from a developer, who sometimes can tell us, however, things go according to how they see fit. Above market returns. I think we're very fair in the way that we structure deals. We're always investor centric. All of our friends and family are in those deals. Of course, our own family members, the company really grew out of those referrals. We have close to 500 or maybe even a little bit over 500 investors, and all of them, maybe 90% of them, to maybe be more accurate, came to us because of you guys, because you were happy, you've done a number of deals with us, and he said, let me introduce you to my cousin, let me introduce you to my brother, let me introduce you to my kids. And we see now second generation within our investors coming in more often in the last few years. Alignment of interest. We want to make sure that those with skin in the game stay in the game. We put our capital into every project as a mandate, but also require our developing partners, our borrowers, our equity players to also put significant amount of money in order to make sure that there's full alignment of interest. And again, this is a personal thing for us, as opposed to click here and send the documents there. We make sure that you have access to us if you need us for any questions, if there's any concern. Things pop up sometimes. and we're here for you. It's very, very personal. It's not just business. Our transactions, as I mentioned, it's a national outfit at this point. We can find our projects in Scottsdale, Arizona, in Brooklyn, in Miami, in various locations from Chicago to South Florida and Westchester, New York, and other locations as well, Columbus, Ohio. We just realized this project came out with a pretty nice return. And that brings us to the end of the presentation. We promised to stop the Zoom call at 6:45. It's now 6:38. We have a few more minutes for questions and answers, so maybe we can go to that segment. And of course, if you'd like to have participation in this project, either through the fund or through a sidecar, this is an opportunity. We prefer that you do it through the fund because this will allow you a commitment throughout the few deals that we're going to be doing throughout this year. 2026 is a turnaround year. Certainly, it feels like all the elements are pointing towards a continuing drop in interest rate, which will elevate the market. We're seeing more and more banks are coming back. It's no longer 60-65% funding. It's now to 65 to 70, in some cases 75%, which means the markets are starting to open up again. And so we'd like to lock in as few and as many of those deals that we can, where we can lock in good amount of interest rate and sort of like enjoy it for the next several years. Laura, back to you with questions and answers.
So I
Beautiful.
think, Joe, the
Yes.
the most relevant one, we had a couple of folks ask, right?
Mhm.
How does this is obviously deal number one
Mhm.
for the
Mhm.
fund,
Yeah,
right? Is that the only way to participate, or can people participate separately? Because I think, timing wise, we'll probably have some folks participating, right, separately as the sidecar as well. Yes.
sure. So if you want to explain the difference between into the fund versus alongside the fund, maybe that's a good idea to discuss that.
Yeah, absolutely. So, as Joe said, right, we think that the fund is very good for diversification. It's a good way to lock in your spot in these projects, but we realize that not everyone's going to want to invest in every deal in there. Plus, on certain opportunities, we may have the ability to have the fund invest, but also bring on what we call a sidecar, right? Somebody that wants to invest. Typically, that's going to be on the higher end, right, 1 to 2 million plus. But maybe somebody that is, doesn't want to or is unable to invest in a fund due to whatever their investment structure might be. We will have opportunities here and there for investors to invest alongside the fund. So we do think that this Newark loan will be that will be the case here, just given the timing constraint of actually when we need to close the project. We're anticipating doing that in late January, potentially leaking into early February. And so, given that it's unlikely to have the full fund commitment at that point, we will likely bring on some additional investors as a sidecar. They will have the same terms as the funds, right? So they're not going to get any kind of different or special treatment, but they will have this, they'll have the same terms. So that is something that for those that are interested in the loan or they're interested in this deal, but they're not interested in the fund, this would be an opportunity for you to participate just in this opportunity.
One of the questions that popped was, what's the mechanism or what's the relationship between us and the funding bank that we're bringing to this project? So again, the way we're structuring this deal, it's a $23.25 million loan. What we do is we finance a portion of the deal to the tune of $16.25 million from a participating bank, a local bank that's familiar with us and certainly very familiar with the area, was lending a portion of the money at a 7% or maybe even slightly below 7%, while we bring in the $7 million. Even the full loan, the full $23.25 million loan is priced at 11.25, while a portion of it we have to pay 16. We're able to generate what's known as the arbitrage, right? Our $7 million enjoys the difference between the first position and our position. Those loans are called bifurcated loans. The priority of payment goes to the bank, and we are subordinating that position. Having said that, Astor is the lender on this project, and while we have an obligation to pay the bank first, while our position is considered junior within the structure, it is still a first position mortgage. It's just that it's created what we call the A-B structure, the A being the $16.25 million, the B being our position. Okay, so it's important to explain that. While there is no other bank, there's no other bank or no other lender in this project, we're only one lender, we're bifurcated inside this one loan. The question in regards to, is there any tax abatement? Yes, there's a pilot program that's obviously very, very beneficial. As I mentioned, two of the other buildings that we've spoke about multiple times throughout this presentation, there's important buildings because they represent additional collateral to us. Also received this pilot program. In fact, all of the new buildings that are being built in the area are receiving this very same program, pilot program.
There's a question from Lloyd, how are investor payouts staged? So we anticipate making payments on a quarterly basis. Basically, for probably that first quarter, we'll hold some back in reserves just to build up a little bit of a safety cushion, and then we'll start making quarterly payments from the second quarter on, right? So that's the plan. I don't know that I saw any other. Adi, we answered a lot of those questions throughout. If there's any other questions, happy to go through them.
We have had a few more come in, Andrew.
I see. So quarterly payments, no catch up. Yeah. So Lloyd, as I assume you're referencing some of the previous preferred equity deals that we've done. There's no annual catch up portion of the payout. It's strictly quarterly payments because the interest is paid monthly, and we'll actually be dispersing that out on a quarterly basis. Adi, we can send you a proposed breakdown. I'm not sure if you're asking for this specific deal or for the fund, but we can send you a breakdown of what a $1 million investment would look like over the course of the next few years. This particular deal, or you put the question term, this deal in Newark is a 24-month loan plus some extensions. There is 18 months of minimum interest. So in the event that the borrower hits exactly what his plan is, right, builds it in 12 to 14 months, leases it up very quickly, and does takeout financing, he will owe a minimum of 18 months. So we're in a good spot there to make sure that we see a good return. The fund itself is about a 3.5 year expected life cycle, right? So 3 to 3.5 years. Deploying money over about a 12-month period, potentially a little bit longer, with most of the investments being about 2 to 3 years in term. So we're expecting about a 3 to 3.5 year overall term. And this loan in Newark is closing end of January, potentially early February. It kind of depends on how all the documentation goes, but we're anticipating end of January at this stage.
We've been taking a good amount of one-to-one Zoom calls with some of you and many others that are not on this presentation right now. Happy to continue doing that whenever we have the interest from you. Just reach Laura, schedule something. We'll get on a call. We'll go into the nitty-gritty. We can talk about tax structuring. We can talk about all those things that are important to you. And with that in mind, it's 6:46. We just missed it by 1 minute. I want to wish you all happy holidays. Thank you very much for participating. Again, we're talking about a day before a major holiday, day before Christmas. We're here. Obviously, not during the next 48 hours or so, but anything that you need, we're available. We want to continue this. We have a lot of momentum. We love this. We're very excited. We feel your excitement on a daily basis. We're filling up our commitments, and it's going pretty well. We also have interest from various larger groups that are looking at various positions. Some of them are looking on their sidecars. Some of them are thinking about putting capital into the fund. So it's really exciting for all of us. I think it's a moment in time. It's 38 transactions that we've done, filing each and every one with the SEC. And this is the first time we're doing a short close-ended fund, and I think it's going to be very interesting. So want to wish you all a fantastic holiday. And if we don't speak again, Happy New Year to you and to your families. And I want to thank you. I want to thank you personally on behalf of all of us for making this great company. Could never happen without your trust, could never happen without your referrals, without putting a good word. You get on a call with us when you have something to say. We're always here for you. Nobody's perfect. We're not perfect, but we're always here to continue growing and learning and doing. And I want to wish us all a phenomenal 2026. Thank you again, everyone. Happy New Year and happy holidays.
Beautiful words, Joe. Thank you so much. Thank you, everyone. Happy holidays, and thanks again.
Thank you, everyone.
Hi, my name's Joe Burko. I'm the CEO of Astor Realty Capital. We started a company about 7 years ago with the intention of bringing quality investment opportunities to our friends, our family. The concept was make sure that capital is preserved, make sure that the investments are yielding the highest possible return, and cycle capital back to the investors in a fairly short period of time. Today, we are participating in over 3.4 million square feet of ground-up constructions in various stages, from coming out of the ground to nearly fully completed, and of course, some pretty amazing exits. Our investors groups have grown. We are now institutionally backed with a partnership from overseas, a public company. We are focused on maintaining the quality, and will continue to maintain the quality of our investments, our transparency to our investors, and making sure that as a collective, we don't just have a bargaining power, but we're also controlling the destiny of where our capital goes and the sort of yields we're able to offer you. You work hard for your money. It's time to let your money work just as hard for you.